Now, we have a range of experienced investors managing our portfolios around the world, and they'll be joining us today. And we're kicking off with our manager of our global property fund, Resolution Capital. And we have the pleasure of Marco Colantonio joining us from Sydney in Australia. Welcome, Marco.
Thanks, Rob. Appreciate it.
Now, there's still some uncertainty about the future of the usage of various property types around the world. But as I'm sure many of you are experiencing a transition to what may be the new world of work. But there's been some anecdotal evidence that suggests that many people are moving back into using more communal spaces. And we'll see, Marco will take us through some of the things evidence that they're seeing within the portfolio. Marco Calantonio is a portfolio manager at Resolution Capital with over 2 decades, nearly 3 decades of experience managing global real estate assets. One of 4 experienced investors managing the portfolio who've been managing global REIT portfolios for 15 years. Now, in that time, they've been outperforming on a rolling 5-year basis every single period relative to the global REIT benchmark. On that note, I'm going to hand over to Marco now, who will take us through some slides that they've prepared for us, reviewing the quarter and taking us through some interesting topics. Please note that on the top left-hand corner of your screen, you'll see a questions box. If you do have questions, you can submit them in there. I'll pick them up on the iPad here. And hopefully we'll have some time for Q&A at the end of Marco's prepared comments. So over to you, Marco. Thank you very much.
Great, thank you. Thanks everyone for joining today. So the last 12 months, the REIT sector has experienced a resurgence in the total returns of just under 30%, which slightly underperformed equities. And of course, that coincides almost with the 12-month anniversary of vaccine news last November, which triggered a strong recovery in the global economy, albeit, of course, as almost always with some twists and turns. And the 2 major concerns over the past several months really have been, number one, inflation, with that strong economic growth combined with some supply bottlenecks causing inflation fears to bubble up. And that certainly spooked the bond markets. And secondly, as Rob mentioned, the financial distress experienced by Evergrande, one of China's largest property developers, which I'll touch upon a bit more in a moment. So that were probably the 2 big negatives that weighed on returns over the quarter, but there are also some positives. We're in the midst of a solid cyclical rebound in earnings for many of the sections of the REIT market that were pretty hard hit by the early phases of the pandemic. And we're also seeing elevated levels of M&A activity in the REIT sector. And so I think the positives during the quarter at least partially offset some of the negatives. And as a result, the sector returned a relatively modest total return of about minus 0.9%, with some of the more economically sensitive sectors, such as hotels, underperforming, and the more resilient sectors like residential and industrial were the strong outperformers. And regionally, you can see on the bottom right of this chart, Hong Kong was the biggest negative, with the fallout from Evergrande impacting here. In terms of fund performance for the quarter, we were in line with the benchmark. For the 12 months, we trailed the market, which has rebounded quite strongly following that vaccine news, as I mentioned. And we're not happy about underperforming, but it's completely consistent with our investment philosophy of preferring high quality, lowly levered companies, which provide very good downside protection, but does tend to trail when you see a strong rebound in some of the more highly levered and cyclical segments of the market, particularly those that had an almost near-death experience last year. And of course, the 12-month period does not capture the initial drawdown in the early phases of the pandemic in early 2020, but the 2-year period does. And as you can see here, our 2-year period excess returns are consistent with our long-term returns. In terms of attribution for the quarter, the positive from a sector point of view came from an overweight position in self-storage, which is experiencing very strong demand and strong pricing power. Similarly, residential, which I'll touch upon a little bit more later, and data centres. and the detractors were diversified, which were predominantly within Asia, and also retail detracting a little bit. And you can see on the right-hand side from a regional perspective that the US was quite strong, and interestingly, Hong Kong was neutral, despite that quite significant fall in the market, highlighting our underweight position, which protected us on the downside. So how does the portfolio look today? Again, as we often like to do when we look at this chart from a sectoral point of view, it really does highlight the diversity within the global listed real estate sector. Many of these exposures are very difficult to replicate in the private markets or as individual investors indeed. So it gives us an opportunity to gain exposure to property sectors that are relevant to the economy and that are leveraged to the major secular or demographic drivers. And currently, 2/3 of our portfolio is exposed to secular growth segments, which in real estate terms we've abbreviated to beds, meds, and sheds. Now, beds refers to rental homes and apartments and manufactured housing communities that are benefiting from the housing shortage theme, which we see in many markets. Meds refers to the seniors housing and life science labs, which are benefiting from the ageing population theme, and also that huge investment that we're seeing in medical technologies, including, for example, mRNA for the development of COVID vaccines, and long-term venture capital funding directed to finding solutions to all the human diseases that still remain outstanding. And sheds is a reference to logistics and data centres, which are benefiting from the e-commerce and the digitisation themes. So that's 2/3 of our portfolio, and we do have select exposure, as you can see here, to retail, particularly focused on the open-air grocery retail centres in the US, where the retailers have really come to appreciate the value of their physical store network in their pursuit of an omni-channel distribution strategy, which encompasses both online, or the three things really: online, in-store, as well as click and collect, which has been a really strong benefit to the retailers who have a physical store network and people wanting more immediacy of delivery or going to pick them up themselves. We've been very selective in the office sector, focused predominantly on modern portfolios, which are trading at large discounts to the direct market, and self-storage, which is, as I mentioned, is enjoying very, very strong conditions, as is often the case when there's dislocation and relocations, and obviously a very big skew to the purchase of goods rather than services with all those stimulus checks during the pandemic. And so people have had to make space at home to accommodate their new kayak. Geographically, you can see very small exposure to Hong Kong at around 4%, no exposure to mainland China, which was important on that topic of Evergrande, which obviously, as Robin mentioned, grabbed a lot of headlines. People are likening this to the imminent collapse of Evergrande to the collapse of Lehman's. Our view is that the writing has really been on the wall for Evergrande for some time. The residential property boom in China has largely been over for some time, and the Chinese government has been actively and publicly warning the highly levered Chinese property developers to delever, including putting in place some very stringent leverage limits, which Evergrande was unlikely to meet. And, you know, indeed, the Chinese president has been saying for some years now that housing is for living, not for speculating. And so the debt and equity investors in Evergrande, we think, will likely lose a lot of money. But as this chart shows, they were playing with fire given the high leverage and the policy direction. We think the Chinese government will do their best to protect individuals who were in the process of buying homes from Evergrande, and for the people who worked and or supplied things to Evergrande, so as not to trigger a loss of confidence in the housing market, which is still a significant part of the Chinese economy. So obviously there's risk to economic growth within China and therefore to the rest of the world, given China's size. But as I mentioned, we've got no direct portfolio exposure to mainland Chinese property developers. In Hong Kong, we have two relatively modest exposures in the form of Sun Hung Kai and Link REIT. Both stocks have significant rental-backed earnings. and very strong balance sheets. So we see very limited direct financial risk to either stock from the Evergrande issue. On inflation, which was the other issue that's been topical, we've covered this in previous presentations at length, so I won't spend too much time on it. But our view is that real estate can act as an inflation hedge. If inflation and interest rates are rising because of a strong economy, that should lead to real estate demand, which can lead to rent growth, and particularly when it flows through into rising construction costs, as it is, as you can see on the left-hand side of this chart. As long as the demand is there for the real estate, the developers will be able to pass that demand on. The other point to make is the cyclical rebound in the various parts of the REIT market that emerged during reporting season, and we've seen a very, very strong comparable year-on-year rent growth for some of the more cyclical property sectors, with which this chart showing the initial impact of the pandemic and the subsequent rebound, which has been described as unprecedented in many circles, with the likes of self-storage seeing 20% increases in year-on-year rents, and retail plus 17%. And while the cyclical recovery has been very strong, the core of the portfolio, as I mentioned, has been focused on beds, meds and sheds. And the chart on this slide shows that these sectors have displayed great resilience through the pandemic, and the recent reporting season also show that they've got strength coming out of the pandemic as well. And so that's very much still intact. Just delving just briefly into some of these sectors more specifically. On the beds theme, residential is experiencing very strong rent growth, as you see an increase in occupancy and in rental rate, particularly in the coastal cities as pandemic restrictions have eased. And also in the more single-family residential, as you've seen growing demand from both the ageing millennials as well as the drift to the Sunbelt markets as people can work from anywhere. And that's coinciding with a structural undersupply of housing, as you can see, post-global financial crisis in the US, in the bottom right of this chart. On the meds theme, seniors housing is an area with increased exposure to post-vaccine. Initially been hit pretty hard by COVID as occupancy levels fell dramatically because that age cohort was hit pretty hard. But they received priority vaccine status, and now many of these aged care facilities are actually safer to be in than those lower vaccinated rates, those cities with lower vaccination rates. And so this is not a discretionary spend, it's a needs-based demand with the ageing population. Construction has slowed significantly, as you can see on the bottom right of this chart. And that was an impediment for us having a big allocation to this segment pre the pandemic. That's slowed down, and occupancy we expect to rebound quite dramatically. And sheds, industrial logistics warehouse, again, we've touched on this before, but benefiting enormously from the e-commerce trend, the supply chain refinements, and data centers are effectively big sheds with servers in them, catering to the digitisation theme that we continue to see going forward. So in terms of the outlook, the long-term consequences of the pandemic and the policy responses to that remain to be seen, including the potential for higher inflation and higher interest rates. Now, we have seen a strong cyclical rebound in many segments of the REIT market, but importantly for us, the long-term secular growth drivers for the more economically relevant real estate segments remains intact and make up the core of our portfolio. And those sectors can continue to deliver strong earnings growth, which can match or even exceed inflation. And while asset prices, because of the liquidity in the system, are elevated across multiple asset classes, we see very limited idiosyncratic risk related to the REIT sector, with relatively moderate construction levels, rising construction costs, generally solid balance sheets, and M&A is occurring within the REIT space because of the availability of assets at reasonable prices, at scale, and very often with good management platforms. And the sector is generally trading roughly in line with equity. So we remain, as always, committed to our long-term investment strategy of focusing on REITs with good balance sheets, with solid operating fundamentals and with quality management. And hopefully today I've provided you with a bit of context around some of the fundamentals and how we're seeing things. And with that, Rob, I'll hand back to you for questions.
Thank you very much, Marco. And we have had some questions through. So first up, thank you, Anton, for sending this question through. Your office exposure, what are you expecting from that in terms of oversupply, demand, and also perhaps any trends that you've been seeing through rental revisions coming through?
Yeah, so we've been very selective in our office exposure. The office component of our portfolio actually includes some lab space and life science companies. So the real office exposure that we have is really probably only about 7 or 8% of the portfolio. So we are underweight. We believe that office is a more challenged segment of the real estate market, given that tenants want more flexibility. They're not exactly sure how they're going to use their space going forward. We're focused more on the very high quality, relatively modern facilities that are in good locations, close to public transport, that generally are trading at significant discounts to the physical markets. There is definitely a bifurcation and in demand for higher quality office buildings. And so that's where we focused our exposure through on the west coast of the US through a company called Kilroy, and in London with Derwent London. And we also have some exposure in Japan where we think there's a minimal exposure to the work from home thematic. But we're seeing, very elevated levels of vacancy rates in office markets, rent growth. There's not a lot of data points because there hasn't been a huge amount of leasing yet, but we expect that, and the leasing that we have seen is being depressed by elevated levels of incentives to attract tenants to commit to leases.
Thanks, Marco. And we had another question through from Robert regarding inflation in the US and whether that's going to remain persistently higher. You touched on it slightly in your presentation, but what impact might that have on your expectations for your US part of the portfolio?
Yeah, so we think just looking at residential rents, as that slide showed, we're seeing a significant spike in residential rents, and that it forms a part of inflation. And so we expect inflation will probably be sticky and slightly higher. And so for us, we have to remain focused on segments of the real estate market that can respond, that is seeing strong demand. And so, for example, in the industrial space where we have a large exposure, that they're seeing rent growth. Today we had one of our portfolio companies reporting as leases come up for expiry, they're increasing their rents by 30 and 40%. So we're well and truly above inflation. Now that's only on the 15% of the portfolio that expires each year, but that alone, combined with the rent inflation that they get through the fixed increases in leases, in existing leases, is driving about 6 or 7% organic cash flow growth for them. And so we can exceed inflation by positioning the portfolio in the segments of the market that is seeing strong demand and relatively tight supply conditions and rising construction costs.
Thanks, Marco. We're just about out of time, but I can't let you go without asking you this question. What are the prospects for the Australian cricket team over the next month or so?
Very, very strong, I believe. I think we're looking pretty good. That's wishful thinking.
All right. Well, we'll see you on Saturday, and I'm sure the South Africans that are watching will have something different to say on the matter. Thanks very much for joining us, Marco.
Sure. Thank you.
Cheers.